Hello viewers, welcome to the 25th show of Your Money, Your Taxes. I'm Lalit Abichandani and owner of Epic CPA Associates. Our episode today is about investment planning and Paresh Ji will be educating us about fixed income investments. Paresh Shah is a CEO of Paresh Shah Financial Services. He is a certified financial planner and a wealth strategist for past 17 years in New York, and he's been helping individuals and businesses co-create innovative financial strategies. He's a licensed CPA presenter educating CPAs as they guide their clients on investments, life, disability, long-term care, and insurance. He specializes in pension profit sharing as well as asset protection and estate planning and succession planning. Paresh Ji graduated as a chemical engineer from prestigious IIT Kharagpur, and he is the 2016 honoree of Long Island Business News Leader in Diversity Awards. Paresh Ji resides in Jericho, Long Island with his wife Shimul and son Shamik. Paresh Ji, welcome to the show.
Thank you, Lalit Ji. Thank you for the great introduction. Really appreciate it.
Paresh Ji, last time we were speaking about investments. Now, investments, when you talk about investment, most people only think about stocks. But you know, stocks have a cycle of going up and down, and a volatility every day. The Dow goes up and down. What about those people who are looking for some safe, secured investment, known as fixed income investment? Can you tell us something about that, please?
Right. Lalit Ji, basically, a fixed income investment is like it's like a loan, a loan to somebody. So the simplest example I can give you of a fixed income investment is a CD. You put a CD in a bank and you put say they give you 1% interest. So if you put in $10,000 at the beginning of the year and you put it for 1 year, end of the year they'll give you your $100 1% interest and your $10,000 back. So that's what basically any fixed income investment is. That means it's a loan. Now, depending on who you loan the money to, that would define what type of fixed income asset it is. So, say for example, if you're loaning the money to the U.S. government, the federal government, then we call these loans treasuries, or we call these fixed income investments treasuries. If you're loaning them to, say, a state government or a local municipality, then these are known as municipals. So municipals are those which are given to at a local level. Now the thing with municipals, they have some tax advantages also. Finally, you may have loans that are given to various businesses for projects, expansions, etc. These are known as corporates. So there are various different types of fixed income investment depending on who the money is loaned to.
Thank you, Paresh Ji. The fixed deposit or a certificate of deposit that you talked about in a bank, that is simple. But everything else that you talked about seems very complex. How does one choose where to invest in?
Yeah. Essentially, we are following pretty much a similar principle, Lalit Ji, to the principle that we followed when we are choosing an investment. That means you want to the higher the risk that you go for, the lesser the return that you can expect. Simple thing, banks have FDIC insurance. So they're probably one of the safest forms of investment, because first you're protected by the bank's capitalization, and then after that, if that bank fails for some reason, then your money up to $250,000 along with the interest on that money will be given to you by the federal government. But then there are certain other more risky investments also, riskier investment. So if you invest in companies and businesses that are very large, we call them they're like the let's say the Apples of the world or the Googles of the world, then that's fairly safe investment. So those corporates have got lower interest rate. But then there are companies which are not so stable, but they need money to to continue their operations, then they have to borrow at higher rates. So again, it's a whole spectrum starting from low interest rates to high interest rates. I'd like to give you one more example. Like, banks give away loans as home mortgages, correct? So they can then bundle those mortgages together and also allow investors to buy into that. Those are known as CMOs, collateralized mortgage obligations. So there's a vast spectrum out there. All I'll say is that if you're willing to accept a higher risk, you can get a higher return. End of the day, bonds do tend to be safer than stock market investments in terms of volatility.
But Paresh, if you're not investing in stocks, then people are looking at guaranteed income. What products can they choose to have guaranteed income?
Right. So, Lalitji, very clearly, the bonds are one such product that we have, which we already talked about, all these various bonds. But besides that, there are also products that are offered by insurance companies, which have fixed rates. Those are known as annuities. Annuities can also be used to get fixed income for those who do not want to take the risk of investing in the stock market.
But annuities typically, I thought they are for retirees, people who want a guaranteed income over a 20-year or 25 years after their retirement. Is that something available to others as well?
So there are actually two types of annuities. I would say two broad classifications. What you're describing is what we call immediate annuities. What immediate annuities means is that you put in the money and then immediately you start getting income from that. Those are known as immediate annuities. But there is also a category of annuities which we call deferred annuities. Deferred annuities are again of several types, but I'll go into two basic broad types of deferred annuities. The first type of deferred annuities is what we call fixed rate deferred annuities. So it's like what money you put in a CD. The insurance company takes the money from you and guarantees you a certain rate of interest. The difference is normally the insurance companies offer a higher rate of interest, but the number of years for which you have to keep the money invested is also longer, typically maybe 5 or 7 years. And if the bank is offering 1%, sometimes these will offer 2.5%, a little higher interest. So these are what we call fixed rate annuities, and they're deferred because currently you invest the money and you do not start taking income, but you just let it grow till a certain date when you want to take it out. Then there's a second class of annuities which is known as variable annuities. In that, what is offered is a bunch of mutual funds are offered under the umbrella of the annuity, and you invest in the annuity and you invest in this series of mutual funds, and the value of the mutual funds could go up or could go down because they could be stock or bond mutual funds, and based on what the value of the underlying is, that's the money that you get when you're about to retire or take income. I'd like to point out one thing, Lalitji, before I just kind of go close on this topic. One might feel that, okay, if you're investing in variable annuities, why are we doing it despite the fact that, it's going to be variable and we want a fixed rate of return? But what happens is that for monies, let's say you have a pool of money which is outside of retirement accounts and you're putting it into mutual funds. Each year that mutual fund company will issue a 1099 on that income that is given to you. You see that
Right.
regularly, correct?
Right, yeah.
So now if you invested in an annuity, the annuity has the blessing like a 401k or an IRA that the money inside the annuity grows tax deferred. So if you want to invest in mutual funds but you want tax deferral, then you can choose a variable annuity.
But the value of that is still going up and down based on this investment in the stocks and mutual funds that you're talking about. But if somebody is looking for a fixed income, is that something available within variable annuities as well?
Variations inside them. So my advice to all viewers is that you must look at the read the prospectuses, go through all the clauses, or work with an advisor or a legal person who can explain to you all these clauses properly and thoroughly. That is the most important thing, because otherwise you might end up with a contract that is not exactly perfect for you or a right fit for you. And because of the costs involved, then you might suffer in retirement. So I would tell people that yes, these are great vehicles for fixed guaranteed income in retirement, but you need to be careful to ensure that you have the right product.
Advantage both ways, that you have a guarantee of 5% or whatever that percentage is fixed at, and at the same time, if the stock market or the mutual funds have done better, then you will get that. Let's say if the stock market or the mutual funds have not done good in that particular year, you invested 100 and now that value is, let's say, 98, but your base is still 105, the 5% plus the $100 that you invested. So from you are having, you can have the cake and eat it too.
Exactly, that is very correct. And I'll give you two examples, real life examples, cases which we actually dealt with. The first case was somebody who invested about $200,000 in 2005. First it went up to about 250,000, and then it came down because of the crash. So after that, from 250 he kept getting the guarantees. Somebody who was invested in 2009 had got continuously all the way up, so he's keeping on getting ratcheting up. So in this way, you're correct that you can get advantage of both sides of the coin.
Absolutely. I think it's a great investment for people who don't understand or don't want to take the risk of stock market and mutual funds on their own. At least the insurance companies are giving you a guarantee of 5% or whatever percentage that you are locked in for a number of years. You can count on your retirement, and they also guarantee over, because you are withdrawing at a 5%, so you know that you will at least be withdrawing for the next 20 years, or in some cases even more than 20 years. So your retirement is pretty solid. So, but you told us that it's available not only for people who are retiring, but also people who generally want to invest, and at least the way that I understood, it will be better if they start earlier in their life rather than doing it later.
Right.
Paresh ji, thank you very much. I have a lot of questions about these insurance products, but we are short of time this time, so we'll catch up again some other day. Viewers, Paresh Shah is a CFP and expert into this insurance and annuities. I would request you to give him a call and understand and sit down with him based on your needs and requirements. I'm sure he will help you out and give you guaranteed income for, if not for your regular life, but at least for your retirement life. So thanks again, Paresh ji.
Thank you very much, Lalit.